Today we're going to discuss Harrow Inc. and why I think it has over 100% upside. Stay tuned to the end for a DCF. Harrow Inc. is an eye care focused pharmaceutical company with a plethora of FDA approved pharmaceuticals. Their ticker is HROW. Harrow Inc. offers a wide variety of FDA-approved pharmaceuticals aimed at treating eye care in patients. If we take a look at our graph here, we can see some of their management solutions in areas like dry eye disease, retina, surgical, rare and specialty products, and compounded. Here's a list of four of Harrow's best-selling products. And what's interesting is you can see they're really starting to pick up some speed here. I'm going to pull out the laser pointer and we can look at the first one, Vivi. I'm probably butchering the name, but Q1 revenue was 21 million and Q2 revenue was 18.6. They're giving guidance for the second half of 2025 to be 60 million, which is a decent clip above here with full year guidance at 100 million. The tell of the tale here is basically you can see, 5 million to 20, 1 million to 27, 20 to 20 million. There's substantial increases in demand for their products. And Harrow Inc. has raised their guidance. They've laid out their path to $250 million in quarterly revenue by the end of 2027, and with operating margins in the 30 to 40% range. And revenue has been accelerating. Look at the chart historically here. They're growing revenue here at a compounded annual growth rate of 77% with 20, and that's only with 2027 saying they're achieving 500,000 when we just heard projections of 1 billion. I keep adding harrowing to the portfolio. I mean, when you have a company set to grow EBITDA at a CAGR of 76% for the next 3 years and a EBITDA multiple that's only reflecting 16 times, I mean, that's a screaming buy for me. Some people take a look at this chart and it scares them off. But in my eyes, these are the kind of charts you want to see. You never want to be chasing the chart, right? You want to be ahead of the chart, right? When it hits the news that the stock's up 1,000%, you're too late. So when I see the stock like this, we're giving amazing forward guidance in the terms of revenue and profitability. And they're seeing strong demand in their four core products, quarter over quarter. It's looking to me like now's a beautiful entry point into the stock. All right, time for my short little discounted cash flow analysis. So basically, this is my favorite part because you love to hear the great stories and everything, but how do you know? Is $10 too much to pay? Is $50 too much to pay? Is $100? You don't know, right? So you got to take the guidance management gives you, digest it, run it through a model, and think about it, right? The present value or today's worth of any company is the present value of its future cash flows. Mathematically, this is the equation that made Warren Buffett rich. So very simply, we'll just go through 2024. Let me pull out my cursor. 2024 is actual, so they made 200 million in revenue and they lost money. They're losing at about 12% free cash flow, and that resulted in about minus $24 million loss. Up until 2027, I have it running through management's guidance here. So analyst estimates has it at revenue at 282 million and 398 million, and management is giving guidance that they are confident they can hit 250 million a quarter or 1 billion a year by end of 2027 with about 30 to 40% profit margin. So, I have it booked up to 1 billion in 27, and then I have it teetering off at 5%, which is pretty low growth rates, and then a 4% terminal growth rate. Looking through free cash flow, 11.9 was the actual, and 17 and 24.4 are analyst projections. And then I have it building up at that 30% in 2027. They said there'll be, guidance for management 30 to 40% and slowly start itching that up. So from 30 to 35 to 40, then I'll cap it at 40%. So you can see now the free cash flow margins are turning positive from 47 million to, and this is true with every DCF, the bulk of the value is going to be in the terminal, right? You're projecting a company into perpetuity, hence the terminal period. Um, So you get 5.7 billion, but obviously a dollar today is worth more than a dollar tomorrow. So 5.7 billion dollars into perpetuity in today's dollars is more like 3.4 billion, and you get that by doing oh my God, one divided by one plus the discount rate raised to zero point 0.5, because zero point 0.5 time value of money affects present value, and right, the sooner you receive money, the higher it is. You want to assume a company receives cash flow steadily throughout a year, zero point 0.5. You can look into the formula. It's called a mid-year convention within a DCF. But anyway, getting back to it, the sum of the present value of the free cash flows is 4.3 billion. They have 55 million in cash. But unfortunately, they have 231 billion in debt because obviously you can see they're not making money, right? So to keep the doors open and operations going, they're going to have to pull on debt because they're not generating retained earnings or equity. They have 37 million shares, which would give us. Oh wait, I think I might have skipped over enterprise value. So you take the sum of the free cash flow and you subtract cash because you could theoretically take that cash, pull it right out, and throw it down to pay the debt. So it would be 231, which is the debt minus the 55 in cash plus our some present value of cash flows, which is equity. So this is the steps from equity to enterprise value, right? 4.3 is equity value, less cash plus debt enterprise value. Now we're at 4.4 billion. They have 37 million shares, which gives you a price target of $121. The stock trades at 37.48. I mean, I'm getting with very conservative inputs. I mean, I usually use 10% for companies this size, sub 1 billion. So I decided let me take it up a little more to 12%. But I mean, if they land on this 2027 guidance of $1 billion and 30% profit, this thing is gonna rocket. I mean, this is an exceptional buying opportunity, and you know, I really enjoy it. And this is why I always frame everything the in the through a DCF perspective, because yes, the idea sounds good, the demand looks strong, but when you run it through, right, the price of a business should be the present value of its future cash flows. And that's exactly what we've lined up. So assuming they hit this 1 billion 2027 and 30% into perpetuity, and we're not even going to give them much credit after that, which is extremely conservative. I mean, they're going to be trading at $121. I mean, this is a great buy in my opportunity. I haven't seen one like this since four. So that's it, guys. That's all I had for you today on Harrow Inc. I think it's a resounding buy if they can really execute on what management has laid out as their guidance for 2027. This thing's going to be beautiful. Hope you learned something. As always, take care, guys, and see you in the next one.